The Federal Reserve are meeting on Wednesday, the 29th of April, and the euro dollar has shown a notable bearish tendency around the Federal Reserve interest rate meetings over the last 5 years. If you look at Seasonax data covering 40 Federal Reserve events, you can see that the euro dollar has fallen in 65% of cases with a negative average return of 0.26% and a clear downside drift on dollar strength immediately following the Federal Reserve decision. So why does this happen? It's because when the Federal Reserve signals tighter policy, that's interest rate expectations moving higher, that strengthens the dollar. And this time there's an extra macro risk. The recent high oil prices has increased inflationary pressures globally, and if rising crude prices feed into the US CPI, the Federal Reserve may be forced into a more hawkish stance, in other words, expecting to keep interest rates higher for longer, or maybe even increase interest rate hike expectations. That can strengthen the dollar sharply. So here's an important fact to add into the mix. Fed officials have also repeatedly flagged energy-driven inflation as a risk factor that can delay interest rate cuts when oil spikes sharply. So if the Fed does turn more hawkish on their interest rate decision on Wednesday the 29th of April, we may well see some euro dollar downside out of the event, and a bearish event setup driven by both history and macro fundamentals is certainly worth looking at for this next interest rate decision out of the US. Don't just trade it, Seasonax it.